Vijay Mantri, MD and CEO at Pramerica Mutual Fund joins in. Vijay, hi, morning. After the recent run-up that India has seen, we've become the most expensive in the region, and the Sensex is at a valuation of, 15 times FY12 earnings. Is it time to exercise caution?
No, I do not think it is a time to log out, because if you look at Indian market from valuation perspective, it is looking at a still discount to last 5 to 10 years average P multiple or price to book value. If you look at the earning growth of Indian equity market, the top line is continuing to grow at, I think, close to 20%. Even December quarter numbers growth on top line was close to 20%. If you look at the bottom line, I think we have seen perhaps the worst quarterly result in December 2011. I think the results are bottomed out, and there's significant upside. If you look at one item is interest rate, second item is foreign exchange one-time losses. I don't think you will see these things in couple of quarters, and the visibility on the corporate bottom line will start emerging over the next 6-month period. So we haven't seen yet the full cycle of when the unleveraging happen, when the interest rates go down, when the one-time adjustment are being taken care of. So if you look from a valuation perspective, if you look from earning perspective, we clearly see there's a lot of legs left in this rally, and it is not the time to cash out. I think compared to 2009, where the market went up significantly and suddenly, investor didn't had opportunity to participate in the equity market. I think 2012 may allow multiple entry point for the retail investor. So if you are an investor and you are investing for 3 to 5 year period, I think whenever you see correction in Indian equity market, you should put money rather than taking money out.
Morning, Vijay. Nikunj Dalmi also joining in. So at Pramerica, what's been your portfolio strategy? Which are some of the key sectors you are bullish on, where you have overweight positions, and which are some of the key sectors which are on your avoid list?
I think we are buying more in the banking space, because we believe the banks are will be in a sweet spot over a 6 to 12 month period. For very simple reason that most of the bad news about the banking sector has already been priced in. The most important news is on the NPA side, and if we looked at the balance sheet of the bank and we look at the what price they are available, many of these banks are available at historical low valuation, and it means that significant amount of NPAs has already been discounted in, and we do not see that NPA is going to be that much in the banking space. The second thing is the interest rate is going to come down over the next 12 to 18 month period. I think that would help banking sector significantly. The third thing, we need to look at the interest rate curve. If you look at 3-month bank CD or 6-month bank CD or 12-month bank CD is available around 10%. And if you look at 10-year GSEC, it is around 820 to 825. So the yield curve is clearly inverted. That suggests that interest rate is going to come down. When the interest rate is going to come down, a lot of NPA would see recovery. So we believe banking sector would be interesting space to be in. It is also a direct play of India's GDP. The second space we are turning bullish is the capital goods, because we believe this sector will see some activities, because the government will come out of the reform post-budget and post-UP election. And the market would see the visibility of these things at least 6 to 12 months now. But the visibility as far as the profits and the activities of the investment side will take 6 to 12 months. But the market will start discounting these things much ahead of visibility on these front. So I believe that capital goods, banking would be the interesting space, and added to that is industrial. I think we are overweight on these 3 sectors. We are underweight on real estate, we are underweight on IT.
Vijay, so what do you like from the cap goods space?
I think if you look at the capital goods, we like in capital goods, we like company like BHEL, we like a company like L&T, Crompton Greaves, Thermax. The other idea we like, and we believe that these companies, if you look at the cycle of these companies over the last 10 to 15 year period, then you figure out what should have been your entry point when you could make money in these stocks. And these company has gone through the challenges where the order book position was not looking very good. The policy paralysis we have seen in past, interest rate going up, the competition from international market. So we have seen, these companies have seen all these things over the last 15 to 20 year period. And what is the best time to own these stocks has always been around the same time. So I think we are looking at these companies.
Vijay, Indian markets are up 20% this year, and that's largely on account of liquidity, but the fundamental turf is not looking exceptionally strong. Factors which got us down in November and December were high crude prices, high inflation, and a ballooning subsidy burden. Can we brush aside all the macro concerns?
I don't think we can brush aside. I think these problems would continue to remain there. I think if you look at inflation, for whatever reason, because of base effect or the food inflation is coming down, I think inflation would come down. If you look at the fiscal deficit, the government has said 4.6% fiscal deficit, market has already anticipated even in last year that these numbers doesn't add up. So market was already discounting all these factors. So even if you look at this year, I think market is anticipating that the government, as far as fiscal deficit is concerned, may hit 5% plus kind of number. So market has priced in all these things. If there's a positive news flow happen, I think then you will see interestingly the market going to the new level. And the positive news flow may not necessarily will has to come from the international market. For instance, if you look at the growth and import, I think the most one important item we have seen import growth is imported coal. If you are able to remove the bottleneck on the availability of the coal, I think the import bill may come down. If you look at rupee dollar play, I think part of the inflation is because of rupee has depreciated against US dollar, and now rupee is an appreciation course. And if that is still there, I think again inflation would come down. So we know that the inflation would remain there, may come down to 6%, but it's still above RBI's comfort level to 4 to 5%. But I think 6% is pretty okay. It may have a chances to coming down further. Fiscal deficit, we know the ground reality will remain around 5%. But in spite of those things, we believe that India is in a good shape, and it will continue to be in good shape post budget and UP elections.
Vijay, I'm going to ask you a tough one, and your discretion, how do you want to answer this one? On a scale of 1 to 10, what do you mind are the chances that Indian markets will touch or will cross the previous high of 21,000?
My sense is that over next 12 months, the market may touch new high, and I'll put 70% chance on that.